Can we see it coming? I mean, that's the billion-dollar question, right? It haunts every single investor. From, the wild gambles of Texas oil heirs to the cold, hard logic of machine learning, we have been desperately trying to figure out how to predict the next big market crash. So today, we're going to explore what separates a lucky guess from a real, data-driven prediction, and see if we can finally separate the signal from all the noise.
Just imagine hearing this on a Friday evening. That's what the legendary trader Paul Tudor Jones actually said to his associate just one single trading day before Black Monday, the single worst day in stock market history. He didn't just feel it was coming. He was betting his entire fund on it. So how do you get from a gut feeling like that to, actual science? Well, before we get to the science, we got to start with the complete opposite, a story of pure, audacious greed.
Okay, so first up, we've got a wild story about two brothers, a massive oil fortune, and an absolutely insane attempt to control an entire global commodity. This isn't just investing. This is trying to become the market.
So, meet Herbert and Nelson Bunker Hunt. These guys inherited billions from their oil tycoon father, and they were terrified that runaway inflation was going to turn all their cash into, worthless paper. Their thinking was, hey, silver, like gold, that's a safe haven. But here's the kicker. They didn't just want to buy some silver, they wanted to own basically all of it.
And the result of their insane buying spree? This number right here, $50.42. That was the peak price of silver per ounce in early 1980. Now, to give you some perspective, just a year before, it was trading for about $6 an ounce. $6! The Hunts' massive buying, using both their own cash and huge loans, created one of the most spectacular bubbles in modern history.
And it all came crashing down, incredibly fast. You can see the buying frenzy starting in '79. Then, regulators who could clearly see this was manipulation changed the rules. They brought in something called Silver Rule 7, which pretty much shut down their whole game of buying on borrowed money, and once their scheme was exposed, the price just collapsed. On March 27th, a day that became known as Silver Thursday, the price absolutely tanked and the brothers couldn't repay their loans. It cost them billions.
So, the Hunts tried to brute force a bubble into existence. But what about predicting one? What about seeing it coming? Well, that brings us back to the guy who saw the '87 crash coming when almost nobody else did.
Black Monday was just pure chaos. The market dropped over 500 points, a 22.6% free fall that just wiped out fortunes. But while everyone else is panicking, Paul Tudor Jones's fund, they reportedly made something like $100 million. See, what he did was he looked back at old charts, comparing the roaring '80s market to the one just before the Great Crash of 1929. He saw the pattern and placed massive bets that it would all come tumbling down. He was a true contrarian who trusted his data over the roar of the crowd.
Okay, but what happens when it's not just a couple of big players making a move? What happens when the entire global financial system feels like it's about to break all at once? Well, that brings us to the 2008 crisis, a total meltdown that started not with silver or stocks, but with American housing. So how on earth did this happen? Well, it was like a perfect storm of dominoes. For years, credit was super cheap, which fueled this massive housing bubble. But the real poison in the system was that millions of these were super risky, subprime loans. We're talking loans given to folks with shaky credit who probably couldn't afford them in the first place. These bad loans were then bundled up and sold to investors all over the world. So when homeowners started to default, the whole house of cards came down.
And this is the financial instrument at the heart of the whole crisis, the mortgage-backed security, or MBS. Basically, investment banks would gobble up thousands of individual home loans, mash them all together into one of these securities, and then sell them off to investors with the promise of steady income. The problem was, a lot of these bundles were just packed with toxic, subprime loans. And when they started to fail, investors were suddenly holding trillions of dollars in completely worthless assets.
All right, so after all that chaos, the big question is still hanging in the air. Can we actually do better? Can we move past gut feelings and pure greed to build something that can actually warn us when this is about to happen again? Which brings us to some really cool research where scientists tried to build, you guessed it, a bubble predicting machine.
The researchers took a really smart three-step approach. Okay, so first, they used this slick statistical method to go back through decades of S&P 500 data and basically find the mathematical signature of a bubble.
Step 2, they used what's called natural language processing, which is just a fancy way of saying they taught a computer how to read and understand English, to analyze the sentiment from thousands and thousands of financial news articles. And finally, they fed all of this data, the economic numbers and the news sentiment, into powerful machine learning models to see if they could learn to predict the next bubble.
The kind of AI they used is called ensemble learning, and it's actually a pretty simple idea. Think of it like this. Instead of relying on one supposed genius to give you an answer, you ask 1,000 ordinary people a simple question. Then you combine all their answers to get one incredibly smart and reliable conclusion. Some of these models learn in sequence, with each one learning from the last one's mistakes. Others do it all at once. But the end result is the same, a really powerful predictor built from lots of simple parts.
All right, so the machine is built. They fed it everything from hard economic data to the daily chatter from financial news. So, what did it find? Well, the answer really challenges a lot of what we think we know about how markets work.
So I gotta ask you, what do you think really matters more? Is it all the drama? The 24/7 news cycle with its panicked headlines and breathless commentary? Or is it the kind of boring, fundamental economic data that gets reported every quarter? The machine, it gave a surprisingly clear answer.
And here's the answer. This chart shows what the model found to be the most important factors. Just look at what's right down there at the bottom, with pretty much zero predictive power. News sentiment. This is the big takeaway. I mean, all that drama, the expert opinions, the 24/7 panic we see on TV. The machine learned that it was all just noise and basically tuned it out completely.
Yeah, and this chart just drives the point home. The top 3 predictors, GDP, a measure of the whole country's economic output, the nation's balance of payments, so the flow of money in and out, and the consumer price index, which measures inflation. These 3 things accounted for more than 75% of the model's ability to see a bubble forming. At the end of the day, it's not about the headlines. It's about the boring, old-school economic fundamentals.
And all of this leaves us with one last kind of haunting question. The data is telling us that the warning signs of a bubble are often hiding in plain sight, right there in fundamental economic reports. The models can see it. So why do we, as humans, keep getting caught off guard by greed and fear and the madness of crowds? Maybe the hardest thing to predict isn't the market at all. Maybe it's us.